Lockheed Martin, LMT, always has been a perennial favorite, having risen from $66 back in 2011 to what I identify really as the high at 505, right around $500 back in 2023. The stock, though, in that time, if we consider that $500 high, it has not gotten above that, other than the ridiculous move where it did rise more than 20% in a very short period, but then gave it all back. So when we look at our moving averages, our smoothing mechanism, we know that this stock has really not done a whole lot in the last 2 years. In fact, here is that moving average. It was sitting around $439 at the beginning of 2023. The stock, the 200 MA now is at 486, while the stock has recently, of course, fallen to 421. But as we know, it doesn't stay below that 200, in this case, 200-week moving average for very long. And this is probably no exception. Now, a couple of things that are problems for the stock, though, that have been keeping a lid on it, especially this year, and that tariffs. Tariffs are a real problem for Lockheed Martin, just like it is for a lot of companies, and we can see that if we go back to 2018. This is 2018. The stock did perform poorly on the tariffs, and that Lockheed Martin imports a lot of its steel. And in fact, some of the steel they import comes from Australia, which is the only place in the world that steel for defense purposes can be sourced. And it had a tariff on it in 2018, and it has a 25% tariff on it again now, coming in from Australia. But however, you can see that even in 2019, the stock did get back on track, having gone from a low of $250 roughly up to 421 in 2019, recovered very well, and it will likely do that again. There is the compounding problem, however. This is one of the reasons why it has not rallied back and been sustained in a rally since back in April. And that's that while Europe is being pushed to spend more on their own defense, well, they're going to spend a lot of that money on European defense contractors and perhaps not spend as much on Lockheed Martin and other American based defense contractors. And so that has also kept some pressure on the stock. Now you add the tariffs, the steel tariffs, it does keep some pressure on the stock. So given the chart, given the history, given the sector, yes, of course, it's a buy, probably a buy right here, and you would not be disappointed in a year or two, but it might take a little bit of time for it to get going, given the dual hit of spending cuts perhaps from Europe and increased costs from tariffs. The stock has had 3 years of relatively flat performance. So, well, again, I think it will get back on track at some point. It might be a little early right now to make that move, but you really probably won't go wrong in the long term picking that stock up on a dramatic drop like we've just had. Anyway, I hope this is helpful. Have a great trading day.